It's another day on Business Morning. Good morning and thank you for joining us. I'm Chimeze Obi Iwagu.
And I'm Ladi Williams. Let's take a look at what's in the news. The National Bureau of Statistics has announced plans to rebase the country's economy to 2018 and the 2019 period. The NBS made this known in a document on the National Business Sample Survey across the 36 states and the Federal Capital Territory, and is being carried out in collaboration with the World Bank. The new plan by the NBS is expected to provide sectoral data at national and state levels using its adopted price benchmark for necessary intervention, which would help increase the real GDP and overall size of Africa's biggest economy. Nigeria's economy rose from $397.19 billion in 2018 to $448.12 billion as of 2019 in the World Bank's economic data.
Well, biggest economy, does it mean a most developed economy? That is left to be seen.
Story, yeah.
Exactly. Yes. So the Securities and Exchange Commission has released general rules for collective investment schemes. According to the document released on its website, the capital market regulator directs that all units and securities of a collective investment scheme shall be registered by the Commission. The rule also prescribes that all units or securities subject to the registration by the Commission may be offered through the following methods: offer for subscription, offer for sale. Units or securities of a collective investment scheme may be registered by way of self-registration.
And the annual meeting of the World Economic Forum, which was postponed to May this year and moved from Switzerland to Singapore, is now expected to hold between August the 17th and 20th. Organizers of the summit attribute the fresh postponement to the pandemic-related challenges, while it reflects the international challenges in containing the pandemic. WEF explains that the 2021 meeting would be the first global leadership summit to address the challenges of recovering from the pandemic and laying the basis for a more inclusive and sustainable world. The annual gathering of the world's political, economic, and business elite was traditionally held in January in the Alpine village of Davos.
And on the global oil market scene, about 2.1 billion barrels of excess oil have withdrawn from the volatile oil market by the Organization of Petroleum Exporting Countries and its allies. In a statement released at the end of its 26th meeting of the Joint Ministerial Monitoring Committee via video conference, the committee further noted that DOC participants pledged to achieve full conformity and make up for previous compensation shortfalls. The move has further raised hopes for the stability of the oil market. Meanwhile, OPEC has commended Nigeria for supporting its efforts, which ensured that 2.1 billion barrels of crude were slashed from the market between April 2020 and January 2021.
And in the meantime, oil prices extended gains this morning after the OPEC Plus alliance of major producers stuck to a reduced output policy. And as crude stockpiles in the United States fell to their lowest levels since March last year, Brent crude futures gained 47 cents to a trade of $58.93 a barrel, having earlier hit their highest since February 21st, 2020, in the wake of the OPEC Plus decision. U.S. West Texas intermediate crude futures climbed 49 cents to $56.18 a barrel after reaching its highest settlement level in a year on Wednesday. The Organization of the Petroleum Exporting Countries and Allies, known as OPEC Plus, extended its current oil output policy at a meeting on Wednesday, a sign that producers are happy that their deep supply cuts are draining inventories despite an uncertain outlook for a recovery in demand as the coronavirus pandemic lingers. Also supporting prices, U.S. crude oil stockpiles fell by 994,000 barrels last week to 475.7 million barrels, their lowest since March. The market was also bolstered by news that Democrats in the U.S. Congress took the first step towards advancing President Joe Biden's proposed $1.9 trillion coronavirus aid plan.
Okay, and for more on the commodities market space, Maiwa Ige, one of the research analysts with Financial Derivatives Company, will be joining us next. All right, Mayowa Ige joins us now. Good morning, Mayowa. It's good to see you again
Morning.
today.
Great to have you again.
Okay, I guess we have to start this conversation from the global oil market. Of course, we have seen price of oil creeping back to the 12-month high, the levels last seen in February 2020. That's about $60. As of this morning, we saw oil at $58 dollars. Now, oil, as you know, is a driver of the Nigerian economy. Is it therefore safe, to assume that at this price level, the Nigerian economy will recover and perhaps post some kind of positive growth?
Well, yes, considering that oil is our major export commodity, and it's also a major source of revenue. So an increase in oil prices definitely benefits the government in terms of revenue. It will be able to fund our budget, especially the budget deficit. When you look at oil prices are usually affected by either supply, it's usually supply demand driven market factors, or you also have market speculations, which is neither here nor there. It's not exactly based on anything fundamental. It could be positive today, negative tomorrow. But currently, we're seeing supply cuts from OPEC's initiative, and then we're also seeing a gradual recovery of the global economic activities resuming. And with all of this, we're seeing a rally in oil prices, and that's the benefit to the Nigerian government. But like when we look at the average Nigerian, it could be more of a negative impact if you look at it, because with oil prices, you see an increase in transport increase in oil prices leads to an increase in transport prices. And transport prices, we know that logistics is a major factor of commodity prices. Increase in logistics costs would affect commodity prices, and we see an increase. And then we also have inflation that we're battling with, and that also adds to inflation. So it has this positive side to the Nigerian economy. It also has the negative
particularly
part of
it. for consumers.
Yes, for
and then
consumers.
Considering that, of course, with the deregulation style of the present administration,
yes.
and when oil prices are going up on international scene, then petrol price, of course,
Would
go up.
Anyway, OPEC has been seen sometimes to be quite fragile, considering how they react to the big producers. How do you think this will affect fragile producers like Nigeria? This output discipline that they're going on at this point?
Well, fragile producers like Nigeria, with the output discipline that they've had, Nigeria has not exactly even been compliant 100% of the time.
Okay.
It's just in recent times, and the reason why we've actually been compliant is because we've had issues with our facilities. So with the resumption in our oil production, we're not even sure if we'll be compliant 100%.
And you think there will be a sanction to that?
Well, yes, there may actually be a sanction to that, but with Saudi Arabia cutting their own production to make up for other producers, because they're aware that other major other OPEC countries are also largely dependent on oil, and so the drop in oil prices has affected their own economy. So they are also struggling, and then OPEC, being a leader, understands that. That's why they are trying to cut their own output to make up for the drop in for the other outputs from other countries. So with OPEC doing that, with Saudi Arabia rather doing that, it may be beneficial to Nigeria. So maybe we wouldn't get so much of a sanction if we increase our production, because Saudi Arabia rather is already making up for that supply increase, that gap. So hopefully you'll help us.
All right. So I'm sure you've been following this market volatility. Well, it's now globally, not just about New York, talking about the short selling squeeze on Robinhood and GameStop issue. Now, Janet Yellen is now calling on regulators to bring sanity back to the market. What is your view about this aberrational, if I may put it that way, and bizarre market situation?
So the market situation really, it's bizarre, like you said. But when we look at it, the SEC will tell you that they have three major responsibilities. They are trying to protect retail investors. They're trying to ensure efficient markets, and also trying to facilitate capital formation. But when you look at it, the hedge fund companies have been having their way. They've always looked at retail investors as not being financially savvy, not being sophisticated enough. So this whole situation is new to them, they never expected it. No one expected it. But then all of this also points to the change in business processes dynamics. If you look at there's been an increase in technology disruptions over the years, and COVID pandemic only fueled that. The reason why retail investors are having this opportunity to play around like this is the rise of fintech platforms. You have Robinhood. It's an app where an ordinary retail investor can go and buy shares, which was not what was common in previous years. So it's a new development that cannot be reversed. It's only going to get more. We're going to see a rise of fintech platforms, and it's also
perhaps more of this kind of disruption.
Yes, more of this kind of disruption. So it really means that this needs to be looked at. Where it's a new phenomenon, it's a new environment. Yeah. But basically, it's this short selling is just, in layman's term, you borrow a stock from an investor. An investor, you sell it at a higher price, and then you wait for the prices to drop. You buy it back and pay back, and then you make your money on it. So that's something that has been hedge fund managers have been doing over the years. It's just a group of retail investors sat down one day and decided that we're going to change.
And they feel they've been cheated.
Yes, they feel they've been cheated.
Yeah,
so,
but then could you see this volatility maybe have a spillover effect into the commodities market?
Well, it could, because if you look at silver, they tried it with silver. When they looked at what was happening with GameStop, they looked, silver too. So they started buying ETFs.
But that didn't.
But that didn't quite work. Yes. So it's not very sustainable in the commodities market. But they did try to see how it will work in the commodities market. So probably not so much. I don't think it would have so much impact in the commodity space.
Okay. So the Naira has been stuck at 480 for a while now in the parallel market. And you projected that inflation rate at 16.2% and food inflation for 20.1%. How much of this price inflation is due to imported inflation?
To be honest, a lot of it is due to imported inflation, because look at it. In Nigeria, our production is low. Even our manufacturers don't have the raw materials produced locally. It's not enough to meet their production. And even our manufacturing is based on importation of raw materials. So there's that forex, that importation impact in terms of there's the import restriction affecting them. There's also the Naira devaluation, currency, forex exchange rates also affecting that side of importation. That's also that's a major factor responsible for this increase in inflation, should I say. There's also the case of insecurity. In Nigeria, our major food commodity producers are in the north, the middle belt. And then we know that insecurity has only been on the rise in those areas. Even now, we look at the issues with headsmen between the south, the southwest, the southeast, and Fulani headsmen. That in itself is another major food crisis just waiting to happen. And then PMS, like we spoke of, petroleum increasing. There's the deregulation that has occurred that has affected the price of petrol. It's also hitting hitting commodity prices, which is jacking up inflation, as we can see. So it's many things in one. But the effect of import restrictions is a major factor driving inflation currently.
Was there any hope, though, of it coming down?
Well, the truth is, even in our projections, month on month there was a decline. A decline month on month in our inflation, and this is because there's been a drop in disposable income. There's an income squeeze, so it's going to limit the rate at which inflation can actually rise, because the demand will drop. People do not have as much money to purchase, so they're only concentrating on essentials. So this is what would help to at least minimize the impact. But also, there's something that we also have to be aware of. Planting season will soon begin, and then when we hit planting season again, there's also going to be a supply and shortage, which would impact inflation, but then the drop in disposable income would help limit or curb, should I say, the rate of increase of inflation.
All right. Okay. Let's look at your commodities price movement for the week. You talked about the price of pepper going down. So, what's the reason for this trend that we're seeing in the pepper markets now?
Well, we have more supply of pepper. Borders are open. I don't think pepper is even impacted by that. And it's just basically we have more supply of pepper right now. That's why we have the drop in prices of tomatoes currently. That's just basically.
Okay. Let's look at this issue of NIN. Of course, that certainly would have some kind of implications on commodities market prices, because we say that commodity markets depend on perfect information for price discovery. So when you have millions, perhaps losing their numbers or losing whatever it is, so that, I guess, obviously will have some kind of impact on commodities market space.
Yes, to an extent, but with the extension, I think that they may even extend it further, because right now is not even the best time to be doing this registration. And then when you look at it, is this registration even necessary? I mean, a lot of people, Nigerians, a high percentage of Nigerians already have their BVN. A lot of people have licenses. They have their international passports. A lot of people have even registered their phone numbers with the telcos. Why can't they sync the data? Why can't they put up an app? I know people say that there's a fake app out there that you can get your NIN number. Oh, and then the NIMC says, oh, it's fake. Or if it's fake, but it can do the job that you need it to do, especially when you look at the times, COVID pandemic, you hear people going to the centers and getting infected because they're in large gatherings. All of these are not exactly necessary, but like you said, it would actually affect dissemination of information if a lot of people are cut off.
All right, thank you very much, Myra. It's always a pleasure to have you.
Great to have you.
Today is Thursday, right? Okay, that's it for the week or so. Thank you, Myra.
Thank you, Myra.
Thank you.
Okay, and when we come back, we will be talking about the recent developments in the Nigerian capital market. And Bolaho Ologunro, research analyst at Quadra Securities, will be joining us next. Bolaho Ologunro, research analyst with Quadras Securities, joins us now. Good morning, Bolaho. Thank you very much for joining us.
Good morning, Chimizi. Thank you for having me.
Okay, let's start off with this negative trend that we are beginning to see in the equities market. Now, is this the beginning of a market correction, or is this just a temporary price adjustment before another rally? Or would you say there is a market crash ahead?
Yeah, so I think since the start of the week, market performance has been broadly bearish. Cumulative loss as at the close of trading yesterday stood at 0.97%. So for us, we think on Tuesday, which is the trading day that we had the highest loss, we think that was a knee-jerk reaction given the uptick we've seen in fixed income markets, particularly long-dated bonds. So we think for some investors, panic sales more or less dominated their reaction to sell down their portfolio rather than fundamental factors. Nonetheless, we don't think that it is an event that would persist in the short term. And if you look at how markets trended yesterday, there was moderation in the loss in the all share index, down by just about 0.2%. So we think it is reflective of the fact that some investors took advantage of the moderation in the price of major bellwether stocks in the prior trading day to make re-entry into those stocks with sound fundamentals and have good history of dividend payments. So with the full year 2020 earnings season already in motion, we've seen corporate earnings from banks, the likes of First Bank, Stanbic, and Fidelity Bank. We've also seen earnings from the likes of Flour Mill and Guinness. which I think on a broad scale, it has been broadly positive, more like decent earnings. So we think investors would continue to search for positive real returns in the equities market, given negative real returns in the fixed income market. As a result, we think that they are likely to rebalance their portfolio towards the equities market, which should remain supportive of a broadly positive performance. And I think thus far in the year, we've started off to a very positive note. As that in the month of January, the Ocean Index was up by 5.3%. So we expect that positive trend to persist in the short term.
Well, many will argue that the uptick we've seen in the bond yield could be the reason behind the sell-off by investors as they expect a continuation of the uptick in bond yields. Is that a case?
Yeah, certainly. I think there is a strong argument with regards to the uptick in yields driving negative sentiment in the equities market. But for us, we think yields in the fixed income market are likely to remain at current levels in the particularly in the first half of the year due to a number of factors. Firstly, if you look at the outcome of the last MPC meeting, the central bank governor struck a dovish tone, which indicates that they are likely to maintain an accommodative monetary policy stance in order to support economic recovery when you consider the fact that the Nigerian economy is currently in a recession, given 2 quarters of decline in GDP growth as at Q3. So we think that monetary policy would remain supportive of lower yields in the fixed income market. In addition to that, we think the DMO is also aware that investors are demanding for higher yields due to the expectations around inflation, which remains biased to the upside. In addition, investors also expect the Debt Management Office to front-load the bulk of issuances of domestic debt instruments in the first half of the year. But nonetheless, we think DMO will try to resist the urge to offer very high yields to investors, given pressure on government revenue that would also weaken the ability to service their debt. So debt servicing cost is also a concern for the DMO. So in that regard, we think they would resist the urge to drive yields at the bonds auction that would take place subsequently in the first half of the year. So for us, we still expect yields in the fixed income market to remain depressed at current levels, despite investors' demand for higher yields.
All right. Now, you did mention the earnings, of course, being in the earnings season. So how should investors trade this earnings season, given expectations of full year 2020 financials to be published by major bellwethers across the banking, consumer goods, and industrial sector?
Okay, so I think one major sector that has been the toast of investors is the banking sector. And if we had to take a cue from banks that have released their earnings thus far, the likes of Stanbic, Fidelity Bank, and FBNH, we think it's been more like decent earnings, although growth in bottom line has been uneven. So we think the major pressure point for banking stocks remains the fact that the low yield environment has put downward pressure on interest income, more so that banks have not also expanded their loan book, given soft macro conditions. Nonetheless, we still think that there are some bright spots that would support banking performance. For instance, banks have been able to make significant savings in terms of cost of running their branches, given that they are not operating at full capacity. So for banks who have been able to deploy cost optimization strategies, that should support their bottom line. Aside that as well, we think for banks who also have net long position in terms of their position in foreign currency, we think they are also able to book foreign exchange gains that would support profitability. And in that regard, you look at the big names in the banking sector, the likes of Zenith and GT, who also have strong capital buffers that would enable them to absorb asset quality issues emanating from the poor macro conditions in the economy. So for us, we have somewhat decent expectations for banking earnings in 2020. And we think for the likes of GT Bank and Zenith Bank, who have a consistent history of dividend payments, investors should continue to take positions in those names. Aside the banking sector, we still think that the cement sector is also a space where investors should take a good look at. We think in 2020, in the first, as at the end of the third quarter, we saw strong top line performances from the three major industry players, and we expect that to persist in the fourth quarter. Although we don't expect that I would see the magnitude of expansion in revenue in Q4 compared to what we saw in Q3. Given that the private sector were also like affected by the protests we saw in the month of December, and persistent liquidity in the FX market has also hindered activities in the construction sector due to increased cost of building materials. But nonetheless, we still expect these cement players to also deliver decent earnings in 2020.
Okay, well, still talking about earnings, a few results we've seen majorly on audited result. What is that signaling?
Yeah, so why we've seen unaudited numbers from some companies is that the Nigerian Stock Exchange has made modifications to the release of corporate earnings. So companies are now allowed to publish unaudited numbers not later than 30 days after the end of their financial year, and 60 days if you decide to publish the audited financials. So that's why we've seen the likes of FBNH, Stanbic, and Fidelity Bank publishing their unaudited numbers. And I think across those three major banks, the only bank that was sort of disappointing in earnings was just Fidelity Bank. But for FBNH, we saw decent expansion in profit before tax. Same thing applies to Stanbic.
Okay, so we've seen the NIN SIM linkage extended, but what impact do you think the ongoing exercise will have on telcos' GDP?
Yeah, for us, we think the telecommunications industry is one of the fastest growing sector. And if you look at the GDP numbers, that sector is more like the bright spots, given the broad weakness across major sectors in the economy. So we understand that since government came up with that policy last year, the industry players, MTN, Airtel, have been restricted from onboarding new customers in terms of registration of new SIM cards. So we think that would likely suppress growth in onboarding of customers in terms of how they're able to gain new customers across provision of data, which would impact on data revenue and voice revenue negatively. But nonetheless, we think it is still a positive move from the government, given that in the economy, we have seen cases of people using registration numbers of legitimate customers to perpetrate frauds, armed robbery, thefts, and the like. So we think it's still a positive move, but nonetheless, it is going to have a short-term negative impact on the telco players.
Well, recent data from the NSC on domestic and FPI participation show that value of transactions executed by foreign investors declined by 22% year on year to about 729.2 billion in 2020. That's the lowest level in 4 years. What drove the decline?
Yeah, so for us, we think if you look at over the last 4 years, we've observed consistent decline in the value of transactions executed by foreign investors. So in 2018, we had hike in interest rates in the United States that triggered capital flow reversals from emerging markets to advanced economies. In 2019 as well, we also had the general elections that heightened political risk in the domestic economy, and investors had to also reduce their exposure to the country. But 2020 was a particularly distinct year when you consider the events that characterized that year. So we had a pandemic, and that pandemic sort of increased global risk of sentiment towards risky assets in emerging markets. And for a country like Nigeria that is vulnerable to the swings in the oil market, we saw foreign investors selling down their portfolio significantly in the months of March and April, when we saw a steep decline in the oil market. So that was the principal factor that drove the decline in the value of transactions executed by foreign investors. Although later in the year, we saw recovery in the equities market. However, Nigeria was unable to attract foreign portfolio investors back into the equities market. And we think the reason for that is due to the fact that the Apex Bank has not been able to restore liquidity in the investors and exporters window. And for us, we think that still remains a significant challenge for the country if we are to attract foreign portfolio investors back into the equities market. And based on our interactions with foreign investors, we think one of the factors they are looking out for in this year, if they are to sort of return back to the equities market, is to have improved flexibility in the foreign exchange market alongside improved liquidity conditions in investors and exporters window. However, they are also looking forward to structural reforms that would also sort of de-risk the Nigerian economy from its vulnerability to swings in the oil market. So we think if policymakers are able to address these two major factors, certainly that will put the country in a better position in reversing that trend of declining value of transactions executed by foreign investors.
Okay, so going forward, what should we expect in 2021 in this regard?
Yeah, so I think in 2021, we still expect domestic investors to remain the key driver and continue to dominate and dictate the tempo of market activities in the equity space, given our expectations of depressed yield environment, particularly in the first half of the year. However, in the second half of the year, we expect that the central bank is likely to revert to a slightly hawkish stance in order to focus on its core mandates of price stability and also stabilize the external sector. So we think if that goes in line with our expectation, we are likely to see some form of sell down from domestic investors as they reduce their exposure in equities in order to take position in the fixed income market. So for us, we think 2021 is going to be a tale of two halves. The first halves, we are likely to see markets more or less showing a broadly positive performance. However, in the second half, when there is a change in monetary policy, which would push yields in the fixed income market slightly upwards, we are likely to see some form of sell down. However, we don't expect the sell down to erase the bulk of the gains that would have accrued in the first half of the year.
Okay, we'll see how that how it goes. Thank you very much, Bolaho, for your time, and enjoy the rest of the day.
Thank you for having me.
Okay, let's look at how the market performed yesterday and, of course, how the market has started off today. And here is Eddie. Eddie, well, there seemed to be some kind of hope despite the red arrows that we've been seeing since the beginning of this week.
Well, Chimi, yeah, you're right. We saw some declines in the market yesterday, but on a less aggressive note than what we had seen in the previous trading day. But just before we go to the numbers, yesterday, the NSE, everyone knows that SMEs are the backbone of, any developing economy. So the NSE held a webinar on, titled Capital Market, raising capital for SMEs through the stock exchange. And, we had the president of NASIMA, we had a lot of groups in there, and we're discussing that. The NSE, we'll know that NSE has been behind SMEs, supporting SMEs. Last year, they launched the NSE Growth Board, which aims to help businesses in their growth phase, which basically caters to SMEs. So that was really that was a really welcomed webinar yesterday in the market. Unfortunately, that did not, have anything to do with the sentiment we saw in the market. The market was down by 10 basis points at 42,001 points, while the equity cap was at 21.970 trillion naira. Activity level was mostly negative. Now, we saw volume decline by about 10% to 504.83 million units, worth 5.31 billion naira. Value was higher by about 20% compared to the previous trading day. And we saw 5,887 deals. Sectoral performance, just like in the previous trading session, was negative all through. The banking sector was down 0.14%, and that was largely due to declines from GT Bank, FCMB, and EcoBank Transnational. We saw gains on Zenith Bank and Access Bank. So, investors took advantage of the lower prices of those stocks in the previous trading session and bought into that yesterday. Consumer goods was down 0.22%. That was due to declines from Champion, Flour Mills, and International Breweries. Industrial goods was down 0.12%. Now, on that counter, we haven't seen a lot of movement from the big boys, as the Dangote Cement and the Boa Cement. What has been moving sentiment in that counter is WAPCO. So hopefully tomorrow we'll be able to talk to an analyst to tell us what is really going on with WAPCO. Insurance was down 2.09%. while oil and gas declined 0.05%. Now, the bond market, I was listening to your conversation earlier. That market, we saw some declines in the bond market yesterday, although not so much because the yields are still at about 7%. So, Chimi, just like you were saying, the bond market is not really, I mean, investors, that segment of the market, we saw yields increasing and then we saw investors leaving the equities market to that space. But with the declines we're seeing now in that space, maybe, investors may be running back to the equities market. I'm sure that will make you happy. Well, we had 21 deals on that counter yesterday worth 9.89 billion naira. For the April 2049 bond, there was a price change there. The day before, we had 136.48. Yesterday was at 143.61. The April 2029 as well, there was some price movement there as well. We had a total of 21 deals. The Nigerian Treasury bills market was quiet yesterday. We had just 19 deals, although there was a lot of activity on the October 2021 bill. We saw 16 deals on that bill alone, and then total we had 13.30 billion naira. The CBN Treasury bills market was quiet, or CBN Special Bills market was quiet. And the Omo Bills market was also a bit quiet. We had 7 deals worth 7.26 billion naira. There's an Omo auction today, so hopefully we'll see how that will shape trading in that space and tomorrow, and we'll talk about it tomorrow on the show, Chimi.
All right, thank you, Eddie. Well, Bolaho says they don't expect to see that trend in the fixed income markets being sustained. So with the moderation we have seen at the equities market yesterday, perhaps there might be some kind of uptick today. Let's just hope and pray for the best. All right, okay, we'll take a quick break, and then when we come back, we cross over to London to talk to Juliana. All right, let's check with Juliana there in London. Good morning, Juliana. Okay, Bank of England's rate setting is today. Some analysts see a hold, but do you think there is room for a cut or a raise?
Good morning, Chimese. Always room for a cut or a change, but the mood music in the room is that no, things will remain the same. We're expecting at 12 o'clock local time, Andrew Bailey to announce that unanimously all 9 Monetary Policy Committee members will agree to keep rates at the historic low of 0.1%. The last time we did see a change was in November. Quantitative easing was increased from £745 billion to £895 billion. But of course, things have changed since then. There have been some negative impacts. The fact that we are in a third national lockdown, we are expecting, all of the indications is that we are heading for a double dip recession. But on the positive side, we're doing exceptionally well with our vaccine rollout. Yesterday, the Health Secretary, Matt Hancock, announced that 10 million people in the UK had been given a vaccination. That's 1/5 of the population. There's a lot of pent-up demand. Consumers are really interested in getting out, booking their summer breaks, going out to spend money again. So I think it's unlikely. We also do have in a couple of weeks Chancellor Rishi Sunak's spring budget. But never say never. I'll give you an update when we speak at lunchtime.
Absolutely. Okay, so one headline on London Guardian says KPMG says UK partners average of £572,000 each. Why does it matter?
Well, it would matter to The Guardian because they are a left-leaning newspaper. And if you think about it, £572,000 every year is a decent salary if you can get it. You know, it's a triple a salary. And they have been speaking to the High Pay Centre think tank, even though KPMG, which is known as one of the big four accountancy firms in the UK, they have decreased the salaries of partners by 11%. So in 2019, a partner at KPMG was earning £640,000 every year. So it has decreased, but they just say it's not gone far enough, that it's almost a slap in the face for ordinary British taxpayers who would have to work for about 20, 30, even 40 years to get some of that salary. But in the article, it does also announce some of the other firms. EY, for example, they're paying their partners £667,000 a year. PwC, $685,000. I'll leave that to you and Laddie to try and work out the rate in Naira there, but it's a lot of money.
That's a very good assignment, and we'll take up that. Okay, UK is now the #1 destination for Australian wine that didn't go to China. Just wondering, what wine are you drinking, even in the midst of the pandemic?
Got to tell you, on the record, only non-alcoholic wine, Chimaze. But, you know, Brits during the lockdown, quite a big story, a worrying story in some parts. They have been drinking more, especially because they're not going out to restaurants, many people working from home to deal with the stress. They're backing wine. But this story really is about the spat between Australia and China. And the Chinese government have packed on 202% of a tax increase on Australian wines. So they've decided to divert it and bring it to Britain, and the Brits are loving it. The sale of Australian wines in country has increased by 30%. I can assure you I'm not one of those buyers, but it's doing really well. And the UK is now the biggest destination for Australian wines.
Interesting. All right, I'll talk to you later in the day.
Thank you.
And to the crypto market now. Here is Laddie Williams. Laddie, Ethereum is trending, and Bitcoin is doing pretty well as well.
Yeah, as I told you, yesterday was at 35,000, today 38,000. The bulls are pushing hard, So the market cap up 4%, $1.15 trillion. That's the overall market cap for the crypto market. 24-hour volume at $152.24 billion. BTC dominance dipped a little bit to 61.8%. And when BTC dominance goes down, it means the altcoins have some room to fly. Bitcoin price at 8 a.m. today, in early trade, $38,036.14, up 3.96%. 24-hour volume, $65 billion. The Bitcoin bulls are pushing hard. They're trying to break the previous high of $42,000. We'll see how that plays out, but they are really pushing. Ethereum still surpassing the previous high of $1,400, now at $1,665. Dogecoin, 4 cents, 27% up today. That could be attributed to Elon Musk. He tweeted today saying that Dogecoin is the people's coin. So, the funny thing about the crypto market is there's always an influencer in a different bull run. The last bull run, it was McAfee. And it seems like this next bull run would have Elon Musk as the major proponent this time. DOT is up 22%. Aave is up 35%. Sushi Swap, that's another decentralized exchange. That one's up 12.99%. Let's look at the top losers. Hedge, down 10%. Luna's down 4%. VeChain down 3%. So the market is not doing too badly. We're going to see how the bulls can push, this time, because they've been able to hold this 30K region for the past few weeks now. Let's see if they'll be able to break the all-time high of $42,000.
Should we go push towards the Dogecoin since Elon Musk is...
the way I like to trade is I like to buy low. I don't like to buy when the price is already high. But, you know, it depends on your risk appetite. You know, if you're able to, you know, buy and expect profit.
This is a highly, you know, risky.
Highly volatile.
And a risk market. And so it demands an investor with a strong heart to really get into that.
Not for the faint-hearted.
Yeah, are you also tracking, you know, a regulator's perspective on this market? I mean, they're very skeptical.
Yes, you know, because recently India actually, they claim India banned cryptocurrency, but we'll see how that plays out. There's still some tussle about regulation when it comes to the crypto space. But, you know, it's Gen Z and the millennials. They love this market. So we'll see how it plays out.
So, in other words, the crypto market might just be it for 2021
it might be here to
and
stay,
going forward.
Yeah.
And perhaps a better regulation can actually help to moderate things there. Okay, so are you advising I go for Bitcoin, Ethereum, Dogecoin? Which of them?
Well, I don't advise anything really, because you see this market is up now. It's down the next few minutes, you know. So, you know, it's better to always buy the dip. My advice is buy the dip.
Which one is the dip at the moment?
Well, it's still high at this point. You see Ethereum now at 1.6. You know, maybe you wait for a little pullback, you know. There's nothing wrong with waiting for a pullback. But, you know, you might not get that pullback. But still, it's about your risk appetite.
And which one are you holding now, Ladi?
I'm not holding anything. It's actually risky for me too, you know.
You really don't have that mind.
I don't have the mind. Really.
All right.
It's a really volatile market.
Okay.
But it's very interesting though.
I know. All right. That's it on the program. Let's just draw the curtain here. Thank you for watching. I'm Chimeze Obi Iwago.